Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. So we will begin today with tariffs and the July 9th deadline for deals with the U.S. Ostensibly, it's pretty simple. Secure a deal by the deadline and avoid those higher reciprocal tariffs. So we know that Japan, South Korea, and India are among those jurisdictions scrambling. Earlier today here in the States, Treasury Secretary Bessent suggested some countries will have the option of a 3-week extension to negotiate. He did acknowledge the sheer number of ongoing talks is complicating the final stages. So far, there have been announcements on a limited framework with the UK, a truce with China, and the outline of an agreement pact with Vietnam. For a closer look, I'm joined by Paul Dobson. He is Bloomberg Executive Editor for Asia Markets, joining from our studios in Singapore. Paul, thank you for making time to chat with me on this. To what extent is there murkiness here as we walk up to that July 9th deadline?
Plenty of murkiness, and not very promising signs. You know, the fact that they're already talking about a 3-week extension for some countries suggests that, you know, there's not that much progress being made in a lot of cases, or that there's still sticking points and matters that need to be overcome, even to achieve some of the more advanced trade negotiations that have been going on. So as the market opened in Asia on Monday, there was a little bit of cautious optimism on the idea that, you know, the US isn't going to move to impose very strict tariffs again on trading partners right away. On the other hand, the market is pretty cautious now about this because it really doesn't know. And at the same time as the administration's been talking about the possibility of an extended 3-week for, you know, kind of trying to get over the line, at the same time it's saying that it is going to be sending out letters to some nations as soon as this week, telling them what their new tariffs are going to look like. So we don't know what the details of that are. We don't know what countries that's going to go to. And that's keeping everybody a little bit in watch and wait mode as we get off to a new week of trading.
So maybe we can focus on some of the trading partners in the Asia Pacific, because I think the initial deal with Vietnam may be a little instructive here in terms of how the Trump administration is pushing countries to cut back on trade with China. And this is something that Beijing has explicitly addressed. How is this playing out?
Yeah, so I think that the Vietnam deal, as you said, was really interesting and important. Vietnam itself had 20% tariffs imposed. That was seen as being okay. It's more than the existing 10%, but it's less than what had been initially mooted, which was somewhere quite a lot higher. So for Vietnamese stocks, that was seen as a reasonably positive sign. The other part of that detail, though, that we got was the idea that Chinese transshipments would receive tariffs of 40%, rather than 20% for Vietnam's exports. And so that points to this idea that, you know, the US is trying to get at China in various different ways. Then again, even with that, the market was not completely perturbed by the idea of 40% transshipments. Basically, there's sort of 3 ways of thinking about this. One, the Chinese manufacturers have been so clever already at finding loopholes and ways around it that they'd probably be able to circumvent it in some way, or 2, that they'd be able to find ways to add enough value in the supply chain in Vietnam that they became, in inverted commas, Vietnamese exports, and so avoided the transshipment costs. And the third thing is that the market thinks a combination of those would mean that the producers on the one hand and the vendors in the US on the other hand would between them be able to manage those costs and pass them through in an equitable way. And so what we saw was companies that are linked to US manufacturers with supply chains in Vietnam actually did well in trading last week. So they continued to post some gains, some relief there that things could have been a lot worse.
So let's talk a little bit about the performance of markets in Asia in the first half of the year, given the fact that we are now at the half-year mark. What was it like in the first 6 months of calendar 2025?
Yeah, so I was really excited about it. I think that Asia's markets are starting to look a lot more positive across the board. We've been at the highest level since 2021 in a number of our markets. Even China is showing greater signs of recovery. And there's lots of other sort of signs of more excited market. Plenty of IPOs going on, not just in Hong Kong, but particularly in Hong Kong. As well as that, we've seen Australia, we've seen India, we've seen Malaysia, all with plenty of interesting ECM activity. And for that matter, the DCM markets are buzzing along quite nicely as well. So it feels like things are heating up a little bit. Part of that is helped by the fact that a weaker US dollar is buoying Asian currencies across the board. I was really excited about that until I talked to my colleagues who were covering Eastern Europe, who were covering Latin America, who told me, calm down a little bit. If you look at your market's performance, if you look at Asia relative to those other parts of EM, actually, kind of like it's still trading in the wake of some of those places where we're really seeing a hubbub of excitement and particularly strong gains this year. So Asia's doing well and it's outperforming the US, particularly if you look at it in dollar terms, but relative to some of the other parts of the EM world, could be better still.
So as long as we're talking currencies, it's going to be a busy week for some of the big central banks in the APAC. I think we'll hear from the reserve banks of Australia and New Zealand. We'll also hear from the Bank of Korea and the central bank in Malaysia as well. I know it's a lot to cover under one kind of broad brush stroke. Is there a general trend here to kind of easier credit, to kind of accommodating the market and supplying rate cuts? Is that really what we're talking about?
Yeah, and let's put it this way, Doug. I mean, everybody's still looking to the Fed, right? And what we've heard recently from the Fed has been the idea that policymakers are starting to think about when they're going to be cutting interest rates. Now, last week, some of the payrolls data and the other economic data meant that people ruled out the idea the Fed would move as soon as July. But nonetheless, people are looking for 2 cuts by the Federal Reserve this year, and that opens the door for Asian central bankers to also feel a little bit more confident that they'll be able to ease monetary policy in tandem with that. So in the Australia and New Zealand region, we're looking at easier monetary policy, but across EM Asia as well, we might be moving into that area where policymakers are a little bit more comfortable about cutting rates, particularly because their currencies have been strong, so that gives them that little bit more wiggle room.
Inflation, I think, is the other part of that story. And if you look at Japan, inflation this year has been surprisingly strong. Is Japan really the outlier here and very unique in terms of what we're seeing across the region?
It is an outlier, and it is really interesting, and they've been so desperate for inflation for so long that the central bank is, really happy that it's finally starting to see it in the economy and very keen to kindle it and make sure that it doesn't snuff it out by moving too quickly, which is why we've seen so much caution from the central bank in terms of how quickly it's raising interest rates. Nonetheless, it is the fact that the inflation is high and it's actually starting to hurt a little bit consumer sentiment and the outlook for the economy too. So what does the central bank do? In a bit of a bind, it doesn't want the currency to appreciate too rapidly either, but it will be gradually signaling that it wants to continue with that rate hike cycle based on everything that we've heard from the central bank governor and particularly the hawkish elements of the BOJ already.
So, Paul, before I let you go, I know we have Chinese inflation data this week. Is this going to be another story about deflation on the producer side and maybe disinflation when it comes to consumer inflation?
Yeah, and I think that, the China story is interesting because a lot of what's driving that has been this really kind of cutthroat price competition that you've seen in various parts of Chinese manufacturing, be it the sort of solar tech industries or the platform economies, the delivery firms, all of that. They seem to be, and the electric vehicle companies too, they all seem to be, really thriving to try to gain market share. And actually what we've heard from Chinese policymakers recently is enough is enough. They're fed up of this kind of like desperate sort of race to the bottom in terms of pricing and razor thin margins, and they'd rather people took out some capacity and that allowed prices to stabilize. So while that might not show up in the data immediately, that is something that is clearly on the minds of the Chinese officials. If you look at what the bond market is telling us, yields are still rooted at very low levels. It shows that people are betting interest rates. Our policy is going to have to remain easy for a long time because of that disinflationary impulse. But at least we see signs that policymakers are both on the fiscal side and on the monetary side are trying to find smart ways to try to prevent that from getting any worse.
Paul, we'll leave it there. Thank you so much. Paul Dobson, he is executive editor for Asia Markets here at Bloomberg, joining from our studios in Singapore on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So major U.S. trading partners hurried over the weekend to secure deals with the U.S., or in some cases lobby for extra time before that July 9th deadline. Now on Sunday, Treasury Secretary Bessent indicated some countries lacking an agreement by the deadline will have an option of a 3-week extension to negotiate. However, later in the day, President Trump indicated that letters regarding tariffs will begin going out to between 12 to 15 partners on Monday. Now, some of these countries are expected to reach agreements. Others are expected to be hit with higher tariffs. We got some insight on this from Trinh Nguyen. She is the senior emerging Asia economist at Natixis. Trinh spoke earlier with Heidi Stroud-Watson Cherry on. Heidi asked the first question on what may appear to be a conflicting picture from the administration.
Well, one thing is very clear is that tariffs are up under the Trump administration 2.0, but the U.S. also needs trade partners. And so the maximalist position we saw on reciprocal trade day is likely maximalist, and we're probably going to settle much lower. And that's why markets are comfortable in that the U.S. needs trade partners. And there's room for Asian policymakers to strike a deal, meaning extensions are likely. Secondly, there's room for India, there's room for Japan, there's room for South Korea, and across the spectrum in Asia to have trade relationship with the U.S. But there's still certainly a lot more friction to trade, and we have to accept that certainty.
We've seen some good news when it comes to sort of frameworks with Vietnam, for example. Does that matter as much when there's not as much certainty when it comes to China? Because it is still sort of the anchor economy across emerging Asia.
Absolutely. What the Vietnam deal shows is that the U.S. needs Vietnam. Obviously, Vietnam needs the U.S. more proportionally than any country in Asia, given the huge exposure to the U.S. and trade in general. That being said, the fact that it climbed down from 46 to 20% with a caveat of 40% on transshipment means that it does need Vietnam to do labor-intensive manufacturing in particular. And the China plus one, if it's going to go hawkish on China, it does need other trade partners within the region. So the Vietnam deal shows that the U.S. will also need countries like India, also Japan and South Korea to do trade for supply chains to reshuffle away from, given the fact that the labor market in the U.S. is very, very tight at the moment and is not competitive in manufacturing. And U.S. firms need Vietnam as much as the U.S. as well.
But will other countries not need Vietnam as much if we're talking about that 40% levy when it comes to transshipped goods? I mean, there was a lot of investment going into these economies because other countries wanted to manufacture there. But will that become an issue long term?
The estimate shows that it's roughly around at the maximum 16% if you look at the Harvard study. The second thing is that the 40% actually will encourage more localization in Vietnam. That's a key issue, is that when you attract FDI into a country, you don't just want to add the final packaging, the final assembling. You do want your inputs to rise over time. And this puts the onus on Vietnam and countries like it over time to move up the value chain, just like China. So I do think that this is a positive. The second one is the fact that China was able to reshuffle its supply chains via these countries means that the U.S. will try to block this round. And an example for Vietnam, the cost for it is the solar sector. The U.S. slapped 400% tariffs on Vietnam solar. And that means that if a Vietnamese company's firms want to export to the U.S., that market is now shut. And the reason why it did that is due to the rerouting of Chinese solar via Vietnam. So Vietnam is a country that has a lot to lose, and it also has a lot to gain to protect its number one markets. The China PPI today shows that the U.S. remains the market with the highest profit margins for U.S. traders. Because onshore in China, we have a situation where demand remains very weak and producers' prices are very, very low, which means the competition for China is very fierce, not just within China, but when it exports to the rest of the region. For the Vietnamese and for the rest of the Asian, the U.S. market therefore remains the most competitive, particularly if tariffs on China remains relatively high and higher than the rest of the Asian countries.
How is the two-track economy in China evolving right now when it comes especially to that slump that we continue to see in the property space?
Well, I think it's one of the situations where it's slowing down, but it's still, I think it's a problem that it's going to amortize over years versus the U.S. where you have a massive crash and recovery. For China, it will need the government help versus just such as cutting interest rates. At the moment, given the fact that the dollar is very weak, it gives it more space to do so. But it's also very vigilant, right, in helping a lot of these deflated sectors. In that, it also looks with a keen eye on what's happening with trade. Export to the U.S. has slowed down materially because of higher tariffs and higher friction. And that's a key driver to growth historically for China in recent decades. So for it, the yuan is an important one. It has appreciated against the dollar, but that appreciation is very weak vis-a-vis countries like the European Union, for example, where it's shot up 14%, but the yuan is only roughly $2 higher versus 2% versus the dollar. So for China, I think it wants to balance the both, being able to help the domestic economy, but at the same time, making sure the external sectors are still competitive. Right. So it needs to export the deflation abroad, at the same time shore up domestic demand.
Trinh, super quickly, because we're out of time, central bank decisions, we have them from Malaysia and South Korea. Anything you're watching?
Rate cuts have been front-loading. Obviously, the RBA will cut, but for countries like South Korea, we now have stable government, which means fiscal policy is at the forefront. So at the moment, Korea is actually sitting pretty comfortable in that the central bank does not have to pull the trigger as aggressively as it did because we have stable politics to negotiate trade and to front-load fiscal spending.
Trinh Nguyen, great to have you back, Emerging Markets Asia Economist at Natixis.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.